Hi, welcome to today's video, which is a little different from the other ones that I have currently on my channel, which is mainly just my aftermarket analysis journal for documenting my journey. But one of the things I wanted to do on this page, as well as document my trading, is to be able to help people looking to get into trading in the most simplest way to understand without having to go through a bunch of videos and stuff like that. But one of the things we are covering in today's is futures trading. This is pretty beginner friendly. I would also say it's intermediate friendly. So if you're very new to the whole trading thing, this is going to cover basically everything you need to know about futures. But if you are intermediate, such as coming from a stock or options background, you'll be able to learn and understand futures without having to feel like this is being taught at a super basic level. But yeah, so we'll be going over that today, as well as at the end of the video, I will be going over up how to set up and get trading and place a trade. All right, getting into the two most common futures contracts you're going to see are going to be the indice futures, which is the S&P 500, as well as the NASDAQ 100, which we will get to on the next slide. There is a lot more futures contracts out there, such as gold, rice, wheat, corn. Something I won't be going over into today's video, but I would definitely recommend to look into that. I'm just going over the indice futures as these are the easiest to get set up in trading, as well as kind of like the simplest to understand how the markets work, as these are some of the two most liquid markets. So first, looking at the S&P 500 or the ES, which if you're not totally sure what the S&P 500 is, again, it's not something I'll be going deep into guide to in today's video, as that's a very beginner topic. But it's basically the top 500 companies in the U.S. stock market. So looking at the S&P 500 mini, or the ticker slash symbol that it's referred to is slash ES. Um, so looking at the first thing is futures move in tick values. So for the S&P 500, it's going every one tick is going to represent a 25-cent increment. So currently, the S&P 500 or ES is trading at 5100. Yeah, 5100. So if it were to say go up a tick, it would be 5100 and a quarter. If it were to go up another tick, it would be 5100 and a half, and so on. So yeah, now looking at the next thing, every dollar increment is going to be referred to as a point or a handle, and there's 4 ticks in a point. So once something goes up 4 ticks, that is going to represent 1 point or $1 move. Very similar, if you're looking at 4 quarters, it represents a dollar. Think of it as in that term. So yeah, every tick value for ES, up or down, is going to represent $12.50 change. Not change, but a change in like your balance or your profit to loss. So yeah, that's every tick is going to be $12.50. Every point or handle, up or down, is going to represent $50. So yeah, now looking over at the S&P 500 micro, which is still the same thing. It represents the same price. It is just a 10 times smaller scale when trading. So the symbol for this is going to be slash MES. It's going to be the same thing for the tick value. Every 25-cent increment is going to represent a tick. Every point is going to represent a dollar increment. Again, like I said, it's just 10 times less. So instead of every tick being $12.50, you're now looking at a $1.25 per tick, up or down, as well as instead of being $50 per point or handle, you're now looking at a $5 point or handle move up or down. So yeah, that's basically it for the S&P 500. Going over to the NASDAQ 100, same thing. Again, not going too deep into what it is. It's just an indice that represents the top 100 basically technology companies or anything that's the tech related. So looking at the Nasdaq 100, which if let's type it mini or slash NQ, every one tick, it's very similar for the tick and the point. It's very similar to S&P 500, or it is similar. Every tick is same thing, 25-cent increment. So currently the Nasdaq is trading at 17,900. If it were to go up a tick, it'd be at 17,900 and a quarter. If it were to go up another tick, it'd be 17,900 and a half. So yeah, same thing. Same thing with a point, represents a dollar increment. The difference is the values for the tick and the point are different. So for NQ, every tick is now $5 up or down. That's going to reflect on your P&L. And for every point, it's going to be $20. So yeah, now looking over at the Nasdaq 100 micro, you have to type this one out as well, or slash MNQ. Every tick, same thing as the rest of it, 25-cent increment. Every point or handle, same thing. It's going to be at a dollar increment. But just like the comparison or the comparison with the ES and MNQ, it's the ES and MES, it's going to be 10 times less. So instead of $5 a tick, you're now looking at 50 cents per tick up or down that reflects your P&L. And instead of $20 per point or handle, you're now looking at $2 per point. One thing I want to get into that a lot of people might be thinking, especially if they don't understand these markets, is that seems very small for the Nasdaq compared to the S&P 500. But the difference is that the Nasdaq moves way more. It's way more volatile. Basically, it moves a lot faster compared to the S&P 500. So although the values again might seem small, it's definitely recommended that you get started on the S&P 500 or specifically the micro, so MES, just because of the volatility. If you're not used to it and don't want to get too scared of how fast it moves, that would be better for you. And yeah, that's basically it covering both of the indice futures. So now looking on to the contract expirations here. If you come from a background of options, this is not the same in the sense there is future option contract, which is definitely something I will not be going over as those are just not commonly touched. I would leave those more as to an institution more than anything. But yeah, it's not the same. When people refer to them as contract, it's not the same as options. But they do have expirations. These contracts expire every quarter on the third Friday of March, June, September, December. There's a reason why these contracts expire. Again, it's not something I'll be going over into. It's more, if you want to look at the very finance terms of things for it, except with, most modern brokerages and things that work today, these manually roll over. So, if you are used to options when they expire, you're thinking, they expire in the money or they expire worthless, and you either, expire with a profit or expire with nothing. That's not how futures contracts work. If it's coming close to expiration, your brokerage will just ask you, or your trading platform will just ask you to roll it over at no additional cost or anything like that, or they will automatically roll it over. It is important to understand why these expire though, just because of the fact that after every quarter, people are looking to trade the newest contract, and you want to make sure you're trading the contract with the most volume. So as you can see here, for the S&P 500, I don't know why I put mini here, but for the S&P 500, whether it be ES and MES, these examples aren't ES, but again, you would just, if it was MES, you would just put the M at the beginning. As you can see here, we have ESH4, which represents the March 2024 contract. We have MES M4, which represents the June 2020 or 2024 contract, and so on. And as you can see at the bottom, letter at the end of each symbol in order. H, M, U, and Z. Number at the end represents the last number of the year for symbol. I, that doesn't really make sense, but for example, the 4 that represents the 2024. If you were looking at, say, ESH5, that would be the March 2025 contract for ES. And then same thing looking over at the NASDAQ. And again, I don't know why yeah, I'm slow. I don't know why I put M at the beginning. Let me change that real quick. So yeah, looking at that, same thing. Again, if you were looking at the micro version, you would just put the M at the beginning. But for NQH4, that's the March 2024 contract, as well as NQM4. Now you're looking at the June 2024 contract, etc. And then same thing, the letters in order, as well as the number that goes at the end is for the year. So yeah, that is the reason, or that is why these contracts expire, as well as the format for each different contract. And one of the ways you can look at which contracts have which contract is currently being traded with the most volume, I will put a link in that for the description. But yeah, it's very important you stay up to date on that. I don't know for all brokerages. I just know, I trade futures through TradingView, which is what I'll be going over at the end of the video. But they have a continuous contract, or like basically contract, which is like all of the contracts. It's yeah, I don't really know the way around it, like the back terms of it, but it's I know I don't have to continuously deal with rolling over or making sure I'm on the newest contract, as it is always up to date. But yeah, so that's for the contract expirations. Now going into the terms, we have lots, long, short, market limit, stop loss, and take profit. So for lot/cons, I'd like to explain to it similar in shares how you're buying a imaginary piece of paper that has a value at a certain price. Although unlike shares, you're not owning the underlying asset. So yeah, again, when just like anything else, when you buy it or sell it, you are owning that piece of paper, imaginary piece of paper, as I like to refer it, that then is going to have a value. But again, just like how it's not like shares in the sense that you're not actually owning it. Whereas, if you buy 1 share of Tesla, you are now considered part owner of the company. Whereas if you if you go long on a lot or short on a lot/a con, you're not owning it. It's just you have a contract agreement that you can sell or rebuy at a future price if you're short for a profit or loss. So now looking at long or short, when people, you can, these terminologies, long or short, can be used for, stock or options. But, most people say like buy or sell. But for futures, these are the commonly used terms. So when someone is saying long, or you're planning on going long, you're expecting the price of the underlying asset class to rise in value, with the value of the contract going up in price as the underlying asset rises, and down in price as the underlying asset falls. So again, very common thing, if you buy a share of a company and it goes up, you're making money while it goes up. And if you buy it and it starts going down from your initial buy price, now you're losing money as it goes down. Now going short, which is basically vice versa of going long, you're expecting the price of the underlying asset class to fall in value, with the value of the contract going up in price as the underlying asset falls, and down in price as the underlying asset rises. So the nice thing compared to stocks with futures is you can make money whether the price of the asset goes up or down. So if you're going short, expecting the price of the S&P 500 or the Nasdaq to fall, you will then buy it back at a later price or at a lower price, and you will keep the profit you made between the difference. So yeah, now looking at just some general things to know, we have a market order, a limit order, stop loss, and a take profit. For a market order, you're looking to long or short at the market price, which will instantly fill you. So again, that's something we'll go over at the end of the video of how to place a trade. But when you when you go long or short at a market order, you're instantly getting filled at whatever the market price is. When you set a limit price to get long or short at it, that's basically you're setting a limit at a specific price set by you of where you want to get into long or short. Now a stop loss, same thing as a limit price, except you're to set a limit for a stop loss. You are setting a limit at a price that will get you out of the trade. Um, I said for a loss, but anyone can you can move your stop to break even, but it's basically where you're looking to stop out of the trade. But most of the time, it's going to be for a loss of where your bias was wrong. Now, when you're looking at take profit, you are setting a limit as well for a price that will get you out at a profit. Which again, we will go over these things at the end of the video. Paper trading, this is more for the beginners, and again, none of this is financial advice, but warning, strongly recommended for beginners. The pros of paper trading: trade without completely anything at risk. You can trade as if it is a or it frick, I messed that up. Trade as if it is live market conditions. You're gaining experience at no cost to you, and you are able to gain the experience and learn how to trade without the whole emotions with live money on the line. Now looking at these cons, again, this should not be worried about till after you have gained experience. So this is more to the intermediates of people that have been trading for a while, which again, not telling anyone to trade with live funds. None of this is financial advice. But if you have been trading for a while, this is something you may want to possibly look at. The cons of paper trading is there's no way to earn a profit while trading. And one of the things I said for pros is the no emotions. But once you've been trading for a while and you're looking to possibly get live funds into it, you can't get the emotional feeling of live funds, which is something you have to eventually experience and overcome in order to uh, be able to do this long term. And then, yeah, again, won't be able to gain any of the psychology experience that also comes with learning this because, again, anybody can place a trade on demo and anything can happen, and you won't necessarily feel any emotional or psychology effects. Whereas once live funds come into play, it is a whole different ballpark. It's a whole different territory when bringing in live funds. So yeah, that's basically it for paper trading. I'm going in order of things how you should do things. Again, it's not financial advice, but this is how, if I were a beginner, how I would definitely do things over again personally. So I would start with paper trading, and then the next thing I would look at is prop firms. Prop firms are able to provide profitable traders with capital without having risk to their own funds in the market at a small cost for the account. Again, if you are going to start or if you are going to get into prop firms, it's something I would only recommend if you have a strategy, if you've been paper trading, if you've tested a strategy and figure out that you are profitable and are ready to have the psychology and emotional thing on the line. The pros for prop firms is they're able to provide profitable traders with an unlimited upside of capital. There's no risking your own capital in the market. You can trade on multiple accounts at once, which I mean, again, you can probably do that with real brokerage accounts as well. But the best thing about this is that you can trade on multiple funded accounts, which means multiple different accounts with no uh, money of your own capital on the line, and still being able to make a profit. And then they also give you that psychology and emotional feeling of something on the line without risking your own money or a major risk, as you can only lose what you paid for the account. The cons, they can be abused by beginners and unprofitable traders. These prop firms, again, I really don't recommend until you believe that you have a profitable strategy that you've proved on paper trading or slash demo, because these can be heavily abused and can be not a good thing for unprofitable traders. Uh, Cons, again, I'm not someone who's an accountant or anything like that or financial advisor, but they're not taxed at, when you're trading through prop firms, they're not taxed at the 60/40 capital gains tax. When you're trading on, through a brokerage futures, and your profit is taxed at 60/40, whereas compared to prop firms, you're technically working as a self-employed 1099, so you don't get that tax advantage. The other con is there's trading rules you have to follow while you're trading in your own brokerage. You can do whatever you want. With prop firms, they have certain rules to keep their risk as well as yours in place. So most prop firms won't let you swing trade. So if you're a swing trader, and you like to trade way in advance and hold trades, overnight, multiple days or weeks, that's not something you can really do on prop firms, as they have certain time limits. And then one of the biggest things that all people like is certain popular prop firms have payout restrictions. So there's certain restrictions, such as you need to make a certain amount in a certain amount of days, and then after you get a payout, then you have to make that same amount of money in that same amount of days, for a little bit, in order to get another payout. Whereas some prop firms don't have any restrictions. As soon as you get funded, you can make any amount of money and take that money out. Except, again, there's certain rules like drawdown you have to follow, which is something you will be able to look at and understand when you take a look at a prop firms. But yeah, that's basically it for the prop firms. Now, going over to live funds, this is where, again, I really want to make this known that this is not financial advice, and warning to not, I'm not recommending anyone to trade with live funds, and if done so, should only be done by experienced and profitable traders. So live funds, not going to go over the pros and cons. It's pretty self-explanatory, especially since I've gone over paper trading and prop firms. The one thing I do want to go over with live funds, though, for futures is, again, how I said it's not similar, or is how that it's not like option contracts where you're buying a contract for a certain price and it can either go to zero or an unlimited potential value. You're not, and again, because you're not owning this thing, you're just having like money in your account, and you need to have a certain margin amount of money in your account. So these are a little bit outdated, but these are very relative to what the current margin and notional value is of these contracts. So if you're wanting to trade basically one MNQ contract in a live brokerage account, this is the amount of value you will need in your account. Again, these aren't exactly accurate, but these are very similar. I think these are from 2021. So yeah, if you want to trade an MNQ contract back in 2021, and this is just one contract, you would need around $2,300 in your account. If you wanted to trade the mini or slash NQ, you would have needed to have around $23,000 in margin in your account. Basically, again, not gonna go super over margin. That's something I would recommend you look on at your own time. but it's basically just it's a way to have the a way to have money in the account to leverage that money. So if you had no margin on the line, a what the actual cost to purchase these contracts would be for MNQ would be around $30,000 for one contract, and for NQ would be around $307,000, which most people cannot put on for a trade. So the most common thing that brokerages do is have margin requirements. And again, there's more into detail for that, which you can look into on your own time. But there's a margin requirement and there's also a margin maintenance, which basically means if you go under a certain they're under the brokerage's certain maintenance amount, you will get what's called a margin call, where they will request that you put more money in your account, as in, your account's losing value. And if you do not add more money in your account or the trade does not go in your favor, they will completely liquidate you and take you out of the trade. So yeah, that was kind of a long explanation, but same thing with the S&P 500 for the MES. You would have needed around $1,500 in your account to put up the trade, and for ES margin, you would have needed around $15,800. And without margin, you to trade, it would have been around 22,000 for MES, and for ES, it would have been around $226,000. The last thing I want to go over with live funds is there is what's called discount brokerages. Again, not financial advice. Warning, not recommending anyone to trade with live funds. If done so, should only be done by experienced and profitable traders. But if you are, you can't put even this amount up for margin. There's discounted brokerages that have what's called intraday margin. So similar to how prop firms work, intraday margin is going to be the margin you need in order to be able to trade between certain times. So, for example, like an intraday margin would be you'd be able to trade from 9:30 New York time, which is the open of the New York stock market, till about 4:15, which is 15 minutes after the close of the New York stock market. So yeah, these discounted brokerages offer people a way to trade with live funds at a much lower cost, which is nice. Again, if you are a profitable trader and you don't have as much money to put up for margin, but they are a little bit more risky, as the maintenance to margin requirement is, it's a very how do you say, like, it's very slim. So although if you're going within what their minimum intraday margin requirements are, their maintenance is not too far behind, so you don't have much wiggle room before you can eventually end up being liquidated out of the trade if the trade is not going in your favor. So yeah, that was basically a way to simplify future trading. I hopefully you guys did enjoy. I tried my best. I'm just now getting back into making videos, so it's something that's kind of new to me, but that is the best way I could explain future trading in the simplest way possible. Hopefully there's nothing I missed out on. If anything, let me know in the comments. But yeah, again, this was a simple way of futures trading. And I totally forgot we are going to go over real quickly here how to place trades and stuff like that. So I trade through TradingView. Basically, when you go to tradingview.com, it will look like this. Reason I recommend TradingView is because it's the most easiest to get it set up on paper trading. So basically here, what you'll do is you'll go to whatever symbol for futures you like. I am on the Nasdaq 100, and this is what I was talking about with the continuous. It's just NQ1 exclamation point. So yeah, that's just the continuous. This is the one I'm always on, which automatically updates the contracts when the expirations happen and when the whatever contract is being traded with the most volume. So yeah, if you're on here, you're just gonna go to trading panel. You're gonna go to paper trading, connect. This is where you'll be able to set up, a paper trading account and be able to put what balance you like and everything like that. So some ways to trade on here, you can either set limits by right clicking, going to trade, and then you can sell or buy. The most common way, the two most common ways that people will do it is they will either press the market order buttons up here. So the red is going to be the sell or short market order button. The top right is going to be the buy or long market order button. And then there is also as well the trading DOM, which I'm seeing if I can get pulled up here, if I can remember how to do that. Um, mm-mm-mm. Okay, I can't remember how to get the DOM pulled up, but it's basically what a DOM is. It's a little tab where you can then place and put orders, and it shows you like the prices and everything like that as it's fluctuating. But that's something you should be able to find just by looking it up. But yeah, I don't really use the DOM that much, so I'm not totally sure. Um, Let me see real quick. Yeah, I can't find it. I don't use the DOM personally myself. But yeah, so let's say here, you're just on your paper trading account and you're looking to place a trade, and you think that your bias says to go long. So what you're gonna do here is this is where you can put the amount of contracts. I'm just gonna stick with the one contract, and let's say you want to go long, you're gonna press buy at market. This is gonna fill you right here. Over here it is going to show you the dollar amount you're up or down. At least that's what it should be. Again, you can change this, whereas you can change it to either ticks or percentage value. I personally just keep it on money value. It's personal preference. And then here is where on the paper trading, you can just, what's nice is you can just drag. So this is TP is your take profit, and it'll tell you in how many ticks your take profit's going to be, and then your stop loss. It will also. So right here we're in what's called a 1-to-1 RR trade, meaning I am risking a 1 unit to make 1 unit. So I'm risking 4.5 points to make 4.5 points. So yeah, these are considered limit orders in the sense that this is a take profit limit order and this is a stop loss limit order. You can also close out the trade just by pressing the X here. But yeah, I'm just gonna close this out right here for a small loss. And again, another way, and if you don't want to do a market order and you just want to get at a specific price, you would just right click here, create new order. You could do it that way, or I just would do trade buy right here, and then I'm just gonna drag it down to right here so I get filled right away, and just like that, I had set a limit order and got filled. And again, on the paper trading, it has this. Some brokerages, like I trade through Tradeovate, I'm not able to drag my TP and stop loss like this. So I don't even know what happened. I think the take profit, yeah, the take profit went behind that. So, what I will do is I will set up, my risk to reward, and then I will just go here, right click, trade, buy a stop, and then I will set my take profit, and then I will go up here and then sell limit. So once my limit down here gets hit, I will get stopped out. And once my limit up here gets hit, it would have been take profit, but ended up getting stopped out right there. All right, but yeah, that's basically the end of the video now. Hopefully you guys enjoyed, and again, hopefully I was able to explain it in a very simple terms. If there's anything that you feel I left out or any questions you guys have, leave them in the comments down below. But yeah, this was just a very basic guide without the whole very financial terms of things. So hopefully you guys did enjoy. And now I will go on to recording my aftermarket analysis for today.